Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about undervalued dividend growth stock. It's a new company that I just purchased more shares of. I currently own shares of it, and I saw an opportunity to buy more shares of it. It has over a 4% dividend yield, and it has been increasing dividends over 25 plus years. So this is a dividend aristocrat type company, and this stock is undervalued, and we're going to look at the fundamentals. We're going to look at the technical chart of it, and I'll show you why I bought more shares at this current price. But first, if you're new to the channel, make sure you hit that subscribe button, and if you enjoyed the video, hit that like button for the YouTube algorithm. So let's get started with the video. All right, so we have here LEG, L-E-G is the ticker symbol. Company's called Leggett & Platt Incorporated. You can see here this stock is going for $39.57, almost 40 bucks. And here's the things that I like, and I'm going to show you more about it, the earnings growth, the dividend growth, as well as the undervaluation and technical charts. You can see here forward earnings projected to be $2.74, and currently the company pays out $1.68 in dividend based on the earnings. It's almost 60% or so, I think. We'll look at that shortly. And the yield right now at 4.25%. I recently just bought shares of this company here at $38.48. I bought 32 shares at $1,231 on the 22nd. So 2 days ago, at $38.48. I am up here a dollar or so. But if we go to my account, you can see here I have an average price of $31. I actually bought LEG down here a lot more shares than 32 shares during the COVID crisis. I bought a lot of shares here. So my majority of the average position here is around $31. So I just added here, and I'll show you why I added. First off, we're going to look at the fast graph fundamentals. You can see here earnings was down in 2020, $2.13, which was a 17% decrease compared to 2019. So this is not too concerning for me because it was a pandemic, and a lot of companies were losing money. But the thing was, LEG was able to raise its dividends from $1.58 to $1.60 during all this. So their earnings decreased, but they continue to increase the dividend. And the dividend, they've been paying an increase of over 20 plus years. I think it's almost a dividend king almost. So you can see here that since 2001, what Fast Graph has, they've been increasing dividends very nicely. They have been slowing down. You can see here in 2019 they increased 5%, in 2020 just 1.2%, and that's okay because that was a pandemic. No one knows what was going on. But here's the things that I like about it. You can see here right now the company has a blended P of 14.5, and historically it averaged a P almost 19, 18.9. And you can see here, this is historically, so you can see here, if the company was to revert back to the 19 or so PE, you can have a 31% annual rate of return in the next 2 or 3 years if it revert back to that PE ratio, the average PE of 18.9 or 19. But let's shorten this time period. That's a historic and a 20-year period. If we shorten this to say maybe, what's this, like 4 or 5 years ago, it averaged around 18 PE. So even at an 18 PE, 18.6, which is a little lower than what it was, 18.9, almost 19, you still have a 28% annual rate of return potential, which is outstanding. And the bright thing is, it looks to be undervalued, because if we go back to the whole graph, you can see here whenever it was under the orange line, it bounced. Over here, obviously during the 2008, 2009 crashes, kept going down, but it was a great buying opportunity, under the PE of 15. So whenever it was under PE of 15, it was a great buying opportunity historically. Even over here, it got close to the 15 PER average or PE ratio, and it bounced, for the next 4 or 5 years. You guys, if you were to able to buy here, even at a 17 PE, you can see here, just say like right here, it had an 18% annual rate of return. So whenever this company looks to be under the 15 PE ratio, it looks like a great buying opportunity. And right now we have a 14.5, so it's under that PE ratio. And even in the 2020 COVID crisis, it was at 11 PE, almost 10 PE, or 9. It got as low as 9.2, and you can see it jumped high, very high, because it had a high yield, maybe around 6% during that time period. So right now we're having a yield of 4.25, and it's expected to grow earnings in this year by 29%. So we only have a quarter left, or basically a few weeks left, and this company is, when they announced the fourth quarter and the full year results, they're expected to be $2.74, almost 29% increase versus 2020, and not only that, is higher than 2019 pre-COVID numbers, which is outstanding. So the management team and the employees have been doing outstanding work. 2022 is expected to grow 10%, and 2023 11%. So this is why I like this a lot, and why I bought more shares of this company, as you saw. If we look at the forecasting, again, analysts are expecting about 16% growth in the foreseeable future. You can see here, you can have a 20% annual rate of return, including dividends. And even if it just stays flat here, what you're getting is a 4% return annually plus dividend increase while you wait for the price appreciation. So this is why buying undervalued stocks is so important. You could wait for the price appreciation while collecting dividends. So that's outstanding. So let's look at Morningstar. Morningstar gives it a 3-star rating for leg, which is a kind of like a buy or hold type of recommendation. Not extremely undervalued or not extremely overvalued, just fair price right now. But you can see here, last close at $39.57. It has a fair value of $44, so it still has some potential upside based on the Morningstar fair value valuation. It does has a moat, a narrow moat, but it has a moat nonetheless. If we look at some of the key statistics here, interest coverage is very good at 7.7. You like to see this at least 2.5 and higher. The debt to equity is pretty high at 1.4, but I like to see this at 1.5 or lower. So that still meets my criteria. You can see here price to earning based on the Morningstar is at 13.5. Price to sales really low at 1.1. That's real good price to sales ratio. So if we look at the revenue, you can see here, revenue grew very nicely in 2019, but in 2020 had a drop, of course, because of the COVID pandemic. But this year, trailing 12 months is at 4.9. So they're gonna hit that 5 billion mark in revenue. Net income is also growing. You can see here in 2018, they made 0.31 billion, 2019, 0.33 billion in net income. And the trailing 12 month at 0.4 billion. So they're still profitable and making money and increasing the net income. So that's something I really like. And you can see here, earnings again growing very nicely. The valuation metrics is very important to look at valuation. The 5-year average for price to sell 1.4, and we're getting at 1.1 price to sell ratio. Price to earnings almost a 19, almost 20 there, and we have a price to earnings at around 13 or 14 based on the Morningstar numbers. And price to cash flow is pretty high versus the 5-year average, but price to book lower than the 5-year average for that. And I'm going to show you, so we looked at the fundamentals. Now I'm going to show you guys the technical and why I bought more shares, because fundamentals is very important as well as the technical, because you don't want to buy stocks at resistance and or sell stocks at support. You know what I mean? Because those projected to be bounce areas or areas that drops. So we're gonna look at the fundamentals. This is the weekly chart of leg. So each bar represents one whole week. And you can see here, the stock was as high as almost $60 here in May. And you can see why it pulled back, because over here, I mean, it passed the all-time high in May, but over here you can see at around $55 over here in 2016, August 2016, April 2017, right over here before COVID, November 2019, it pulled back in that $55 area. It got over here, 55, pulled back. Got over here, 55, pulled back. Over here, had a huge pullback because of the pandemic. And right over here, it went higher than 55 up to about, what's that? We got here around high as $59, almost $60. So $5 more and then pull back. So right now, if I was to, you know, with the shares I bought, if this stock was to go back to $60, I think I'm gonna sell, because that's strong resistance here between 55 and the $60 range. So I'm possibly gonna sell depending how it gets there. If it takes a while to get there, I'll just continue holding. But if this stock break this trend line, and we're gonna talk about that shortly, break this trend line and jump to $60 and, you know, before the end of next year, I'm gonna sell, because that's gonna be a huge run up for the next year. If it gets back to $60, then I'll sell, because it got there pretty fast. And when that happens, when the stock gets there fast, it pulls back just as fast, or maybe half of it, and then I'll buy back with the profit and buy more shares. But anyway, the only thing I'm concerned right now here is the trend line here. So this is a trend line. This was the high, and this was a pivot point, and this created this trend line. So one concern I have here is that it'll bounce here, and then this trend line will push it back down. But if it does, you know, and it gets back down here again, I may buy some more shares. If it doesn't, you know, hits this trend line, maybe does a slight pullback and then breaks it, right? Then we have a new trend line going higher and taking this back to that $60 mark. And one of the reasons why I bought shares at this price under in that $38 range is because of the support. You can see here it got as low as $35. So $35 is very strong support. However, you know, of course, COVID pandemic, it broke that support strong, went as low as $22, but that's because of the once in a lifetime type of event, right? So that happened there. So if this stock was to drop, the biggest support area would be that $20 range, but I don't see that happening, because then the yield will be almost, you know, 10%, and that'll be great. But I don't see that happening. But I do see it maybe getting up higher to $40, $42, and then coming back, maybe back to that $35, $37. But I still bought shares because I really don't know. But I do know that right now is a good area to buy shares. And if I show you here, we do like a buy right around there, like that. You can see right here, this $35 area back here in this time period was resistance. It bounced here, it got up to here, it pulled back, got up to here, pulled back, and then it finally broke out, boom, right? It broke out. So this was once resistance, 35. So what was once resistance becomes support. So, and then you can see here, right here bounce, right here bounce, here bounce and bounce. And I'm expecting this same kind of results, bounce. So this green area is great buying opportunity. So from under 40 to 35, it's great buying opportunity for leg. This is why it's so important for long-term investors or investors in general to learn how to read charts. Very important. So you could buy stocks that you like at support level. So very important to learn how to read charts. And so overall, I like this company. As you can see, that's why I bought more shares, 32 shares. And again, I have more. I have 104 total shares. I'm up almost $900 with an average price around $31. You see here for leg. So overall, I like this company. Earnings are expected to go higher. You can see there in the fast graph. So earnings expected to go higher. The dividend yield looks great. The debt to equity ratio is decent. But overall, solid company with a high dividend track record of increases. So overall, this stock is a buy. I bought shares. Make sure you do your own research. If you enjoyed this video, hit that like button. And if you're new to the channel, make sure to hit that subscribe button for more video content like this. I'm a dividend growth investor, and this is what I like to do. So I'll see you guys in the next one.